So opportunity zones are one of those things as a real estate agent, I've heard about great opportunities, but frankly, never been able to participate. And really, I've had the opportunity to meet an expert in tax advantage strategies. We previously did a detailed video on Delaware Statutory Trust, DSTs, a form of 1031 exchange. I'm really excited to bring today Lyndon Grey again to talk about, in particular, opportunity zone investing and investing here in Los Angeles and next to my alma mater, USC. Lyndon, thank you so much for joining us today.
Thank you much, Bill.
So let's talk about opportunity zones. What's the nature of an investment in an opportunity zone that makes it so interesting and talked about?
So a little backstory, the opportunity zone was introduced in 2017 under the Trump administration, under the Tax and Jobs Act. And then it wasn't really until 2019 when it really started to take hold, because they had to fine tune a lot of the legislation. So once they did that, the main objective for the opportunity zone is to incentivize the private sector to move money to blighted areas that need to be gentrified, need some just some uplift, create jobs, create opportunity, etc. And so if you're selling shares of Amazon, or you're selling a business, or you're selling commercial property, you can certainly utilize an op zone. And part of the legislation specifically that makes it attractive, whatever dollars are in an op zone, if they're there for a decade, whatever gains you get are totally tax exempt. So if $1 million turns into $2 million over a decade, you can basically have that money go to your bank account, and Uncle Sam that basically does not come after you for any kind of tax liability. Taxes, however, are deferred to a certain year. 2026, you get some deferral of those taxes, and then they'll be paid at that time. So those are the two main bullet points: the tax deferral and the full tax exemption of the portfolio.
Now, I've had these things described to me in theory over the years, and they sound interesting, but it's hard to get my hands on. And when you say blighted, of course, you assume, well, that means it's an area I don't invest in. But I think really the opportunity is where there's the edge of blight, and yet there's economic potential in that blighted area to bring forward. I was really impressed when you sent me the package that one of the investments of this portfolio I know really well. In fact, I've been physically on that site in its prior, and that is a investment called the Hub LA Coliseum, which is a student housing proposed on Figueroa near my alma mater, fight on USC. So talk a little bit about that particular investment and how that is, it's blighted, yet there's certainly a market there for this kind of property.
Exactly. So today's blighted area is tomorrow's hip. Let's go there, let's have some drinks, etc. That's basically what happens when you put in millions and millions of dollars in these areas, and you put down quality quality assets. They end up being a turnaround. Look at downtown LA. You bring in an anchor like the Staples Center, and then the hotels come, the restaurants come, etc. Same thing with the student housing. As you well noted, that area was a blighted area, and now there's a $100 million student housing facility there, and it's A-class, A-plus type property, fully amenitized with game room and rooftop deck and pool and quiet areas for studying and office space to meet and group and strategize among students. And then the bottom floor will be Buffalo Wild Wings, where students can hang out, have a drink, watch a game, etc. So that's an asset that's fully leased up with basically a waiting list. And with student housing, it's quite a great niche within the multifamily space, because mom and dad is on the lease, number one. So you're not chasing down 18-year-old freshmen for the rent money. Mom and dad's checking account gets dinged on the 1st or the 15th of each month. And then the pricing for student housing, you might have 4 beds in one unit. It's priced per bed. So it's not like a traditional multifamily. They have a common area, kitchen, and so on, but you're basically pricing per bed. And so when someone moves out, you bump the rent 10, 15%. And as you can see, the turnover is quite frequent in student housing. Students graduate, et cetera. You turn that over, and the other freshman class or sophomores come in, you bump those rates. So it is quite an attractive area for clients who are have sold a business, also have sold a real estate property, and they've missed their 1031 window. They can utilize the the qualified opportunity zone as a way to defer, reduce, or eliminate, or delay, I should say, the taxes, because you have 6 months after escrow closes, unlike a 45-day 1031 window. If you're in the 46th day and your client wasn't able to find a property, this is a way they can shelter some of those gains and grow them tax deferred and tax exempt fully over the next decade.
This particular property near USC, the Hub Los Angeles Coliseum, that's built already?
Yep, it's live. It's cash flowing already. I have a client in it. Basically, we took some gains off of a lot of equity positions because of volatility of the markets, and we shifted them to real estate on a passive level inside of the opportunity zone. And she got her first or second check based off of that property because it's cash flow and it's fully leased up. And it's about a 3.5 or so dividend that's being received now. So the objective is to have about 6 or 7 of these properties next to Florida State University, next to other major universities throughout the country. And once they're all cash flowing and leased up, they will pay out 5 or 5.5 dividend. And then you sit on those assets. They basically over time appreciate in value, and then they sell them off to a pension fund, endowment, insurance company, et cetera. And those gains will be fully tax exempt.
Just to go through this particular project, I know the area so well. So this is Hub LA. It's directly across the street from the Coliseum, Exposition Park, and the museums. This used to be Julius Trojan Barrel for people who've been around for a while. And it was just like a hole-in-the-wall little restaurant. They had parking, and you could park there and then get a beer before the game and walk across the street and watch the Rams play in the day or USC play football and hang out afterwards. And it was really a blighted street where nothing was done for a long time. The campus is north of Exposition for the most part. South of Expo is the museums, the Coliseum, and what was Bank of California Stadium. I think now it's BMO Stadium, the soccer stadium for the soccer team. And so you have this area that has been completely redeveloped. South of campus, you have north of campus, the largest private employer in Los Angeles is USC, and there's a need for restaurants, foods, and local housing. This was one of the most dangerous, terrible areas to be in, but just the economic force of all this development is changing it over. And you're on the west side of the 110 freeway. You're also near all these amenities, really world-class amenities and world-class features. It's a very unique property, very unique opportunity. So you're saying the dividend so someone would invest today, they'd have to be an accredited investor. It'd be a minimum $100,000 investment, and they'd be getting today, based on the current numbers, the actual numbers, dividend of 3 or 3.5%. And then the expectation would be at some point in the future, their property is sold and they're going to get some sort of profit based on the appreciation.
Exactly. So and another thing about the opportunity zone legislation, you can retain your cost basis. So if something costs you $500,000 and you sell for 1.5 or whatever, you can keep that cost basis in your bank. Unlike a 1031 where you keep the cost basis, it's still a taxable event in the eyes of the IRS because it's prorated. It's like all of that is not cost basis. Maybe a third or a quarter is cost basis, but some represent capital gain, et cetera. So you have to pay tax and you have to reconcile that come April 15th. With the op zone legislation, however, one can keep their cost basis fully, whether it's $1 million or $5 million or 500,000. And if they sell for much more than that cost basis, then part or some or all of that cost base, that gain can go into an up zone and get full tax exemption into the future.
Now, you and I spoke a few months ago on my channel, and you talked about at the time DST 1031s, where rather than having to sell a property and identify and move into a property individual that you would own, that you had properties were kind of like buying mutual funds, kind of like stocks, in that you could pick and choose multiple properties, diversify. These were properties were being professionally managed and run or whatever. Is this property eligible as a DST?
No, it's one or the other. The legislation is specific. The DST legislation is under IRS Revenue Code 2004-86, specific to DST, where it says you can take a DST to satisfy a 1031 exchange, percentage ownership of a portfolio. The Opportunity Zone legislation is its own wheelhouse. It does not, you can't commingle. The Opportunity Zone legislation basically says you get tax deferral into 3 or 4 years out and full tax exemption for if assets are held for that 10-year period. I always say, if someone is coming out of real estate, definitely go back into the DST 1031 space. Utilize the op zone if you somehow fell out of escrow or you couldn't find a property within the 45-day window, because even if that money, or if someone made a mistake, say the money went into their bank account and their intention was to do an exchange, well, that's irreversible. So you bring in the op zone to then kind of pick up the slack there, where you can get some relief, as opposed to, oh my, I blew up my exchange, I'm fully taxed. Okay, here comes the relief pitcher, if you will, to use a baseball analogy. The Opportunity Zone can be that relief pitcher to save you on some tax liability.
Well, I love this particular project. I wish I'd seen it a little sooner, but I'm sure you have others as well. And I know this company, this particular portfolio has several other universities, and you have other projects. So if somebody's interested in learning more about using Opportunity Zones as an investment vehicle, what's the best way to move forward with you?
My number is on the screen, and you can certainly give me a call. And my email address also is lgrey, Grey, at wisdirect.com.
Fantastic. We'll put that in the show note description as well. I'm not going to attach to that document. I'll let you do that when appropriate to customers. I don't know the rules and regs and all that, but correct. I was excited just to learn about that particular project being in Opportunity Zone, because again, I've always heard about blighted properties, and this is the second time I've seen one where I'd say, well, it's not blighted. Well, it's not blighted now because they developed it. It was blighted when they bought it. And as an LA resident and as an alum at USC, wow, thanks for taking that eyesore and making it into really hot student housing and a great project for people to take advantage of.
Indeed, indeed. And a lot of times when the Opportunity Zone first came out, the legislation, people thought, oh my, I can buy a property and fix it up and so on. But the Opportunity Zone map has been laid out through the governors of each state. And they took 10-year census records and basically circled the map and said, okay, this is an op zone, this is an op zone, and so forth. Initially, the mom and pop thought they can go in and pick up a property and have it in an op zone and be okay. But the legislation also specifically states, if you pick up a property for $2 million, you have to come in with another $2 million and basically clean it up tremendously. You're not just going to come in and knock out some doors and change the carpets and spend $300,000 and then call it an op zone project that's capable of full tax exemption. So they were trying to definitely bring in big dollars, and that's where the big boys come in, because they can take down a property, totally tear it down, and go clean up from the ground up, and spend $100 million on an asset, and so forth. So it's attracted the big players in the space, and that was the intention, to bring in the deep pocket players to really revitalize communities.
Well, and transform a neighborhood, really. They really that area is completely different as a result of that and several other nearby investments. So, well, great. Look, I appreciate, as always, learning from you and sharing with you. When customers ask me, I have a place to take them to. I appreciate your time, Lyndon. Thank you so much.
Thank you. Have a good day.